Hey, hello everyone. I'm Paul Moore with Wellings Capital, and it's great to be here with you today. So honored to be part of the left field investors community, and that you joined me for this time together. Today, we're going to talk about destroying myths about hold times and risk-adjusted returns. And as a little bonus, I'm going to add a frank discussion about liquidity and illiquidity. So hopefully this will benefit you. I think if you're a passive investor or you're planning to be, this is a talk that's going to really give you some mindset shifts and a philosophy for what you're doing and help you defend yourself around the Thanksgiving table for people who are just into other types of investments like Wall Street, bonds, stocks, etc., as well as help you decide how long you want to hold your passive investments for. So, a little disclaimer here, we're not directly affiliated with left field investors. We're not endorsing them, they're not endorsing us. But we are glad again to be part of this community. If you don't know me, I'm Paul Moore. I'm a fund manager, founder of Wellings Capital. We have 6 commercial real estate funds that invest in multifamily, self-storage, RV parks, all types of other assets. I've written 3 books on real estate investing, and more importantly than all that, I am actually married for 37 years this month, and we have 4 adult children. So I have heard this comment over and over more than a few times. I imagine you've thought it or heard it yourself, and I have no idea how many times this went unspoken in discussions with investors. They say, I think I'm going to pass on this one. Your 10-year hold is too long, and I doubled my money in 5 years last time. I'm going to look for another deal like that one. And I get it. Another prospective investor looking for a shorter hold time or trying to double their money twice in a decade. I really get it. The IRRs are bedazzling. We've had a decade long of straight upward runs where cap rates compressed, people made a lot of money, and there was no reason for a lot of people to think about holding for 10 years. But it's not always the norm. And a decade long hold period while it might throw a wrench into the world of instant gratification or people who are, FOMOing, fear of missing out on a better opportunity. Today, I'm going to argue that it might be a little different than you think. The hold times, the returns, the risk, and the whole issue, like I said, of liquidity and illiquidity. Let's see what Mr. Buffett has to say about this. Did you know if Warren Buffett and Berkshire Hathaway lost 99% of their stock value, they would still beat the S&P 500 by about 40% over the last 58 years. So he's probably somebody we should listen to. What did Buffett say? Buffett said, successful investing takes time, discipline, and patience. No matter how great the talent or effort, some things just take time. You can't produce a baby in 1 month by getting 9 women pregnant. That's what he said. So I think it might be worth looking at, again, these longer hold times. And our question for the day seems like it has an obvious answer. Here's the question. Isn't doubling your capital twice in 10 years an apparent 4x multiple on invested capital clearly better than tripling your money in one 10-year hold? And the answer, it seems obvious, but the answer is not obvious. The answer is no, it's not always better. So here's our hypothesis. When comparing 2 investments where one is projecting a 2x multiple on invested capital in 5 years and the other projects a 3x multiple in 10 years, many investors will immediately gravitate toward the former because they believe they can reinvest that 2x into a similar investment and get a 4x return in 10 years. But employing this obvious math, some investors miss several key points that really should be included. And I want to thank Troy Zafka our director of investments at Wellings Capital, for giving me the fodder and the math for this. Now, what's missing from this analysis? There's at least three important elements missing, and then we'll jump into the math a little bit. First of all, taxes. Now, when exiting that initial 5-year investment, there will be capital gains tax assessed. And this can be mitigated somewhat through a lazy 1031 exchange, which is basically getting another asset in the same calendar year with a lot of depreciation. But we actually don't know what Congress is going to do with the depreciation law. They may not put it back to 100% bonus depreciation. And so it's likely, or certainly possible, that that depreciation, that lazy 1031 exchange, so-called, and if you don't know what that is, feel free to reach out to me. I'll tell you more about it. But the new investment after 5 years will be less than 2x. In other words, if you double your money, you take 100,000, turn into 200,000, you won't have 200,000 to invest because you'll have a capital gains bill to pay. And that's pretty obvious. Second, there's risk. Experienced investors aren't just seeking good returns. And I know you left field investors know better. It's not good returns we're all looking for. We're looking for good risk adjusted returns. An investment that achieves double 2x in 5 years will almost certainly be either a development deal, an opportunistic deal, or a value add deal. And there's execution risk associated with all these types of investments. And there's nothing wrong with that. I love those types of deals, but there still is execution risk. By the time the 5-year mark is reached, the asset will be restabilized at a value that achieves the 2x return. It will likely have more long-term fixed, it will likely have long-term fixed rate debt, and the investment will be significantly de-risked. Now, if that asset is then sold, keyword sold, and then the proceeds reinvested into a new asset with a 2x likely multiple in 5 years, the entire original investment amount, that's 100,000 turned into 200 in my example, plus the gains net of tax liability, will be subject to an entirely new set of execution risk. And we're going to dive into that really deeply today. Choosing the investment plan of making 2 investments over 10 years effectively doubles your execution risk to which the original investment's exposed. Okay, so that's the second issue. We've got taxes, we've got risk, and we've got friction. It's easy to invest in a syndication. You can do that the same day you hear about it. I just got a call today from somebody who Googled us, and he could invest today. But it's hard to perform the appropriate due diligence on the operator. Learn about their track record, their team, their debt, their underwriting, and 100 other things that you need to study and inquire about before moving forward. Doing this once in a decade is hard to do. Doing it twice in the decade, well, I mean, it's possible, certainly. We've all done that. But most investors don't have the time, the tools, and the resources and the patience to do this really, really well. So doing it twice as often every 5 years doubles the effort, the time, the travel, and the expense. And if you're putting all your money into something you rushed into, or if you wing it, well, look, I'm all for praying, but that is not a sound investment strategy for most people. The friction costs here include potential time away from work, vacation time you chew up, time away from family, time away from retirement, pickleball for me. Rushing in could just add to your risk. Furthermore, we need to account for the potential lag time in making the second investment. In other words, the day you get the money out of the first, you can't assume you can just plow it right into the second one. There may be a slack time, and that may put some cash drag on your scenario. So let's take a peek at the math. Is the investment plan of 2x twice in 5 years really more lucrative than a 3x in 10-year investment? Okay, so just want to be clear. So we're going to keep as much constant as possible in this to make it simple. We're going to assume that is the exact same investment strategy with the exact same asset in if in the first or the second plan. One aims to sell in year 5, while the other aims to refinance in year 5. That's part of the key to access the forced equity achieved through the execution and then the hold for another 5 years to achieve that 3x multiple on invested capital and 10-year hold plan. If that's not clear, it will be in a minute. Now, we're going to demonstrate with a $100,000 investment amount. And for simplicity, we're going to assume there's no cash flow along the way in either case. And you may object to that, but that doesn't change the answer at all. The only cash flow will be from the sale or the refinance. Cash flow would just muddy the water and not add any additional benefit to the outcome at all. Okay, so where are we at in year 5? In year 5, the first investment is de-risked and has achieved an asset value that translates to a doubling or a 2x multiple on invested capital. So with investment strategy number 1, the asset number 1 is sold. It creates that tax liability we talked about, and the remainder, which is 200,000 minus the tax, is reinvested into a similar deal. That's asset number 2 with a new set of risks. Okay. So there's a sale and the reinvestment of the entire net amount. So 100,000 turns into 200, 200 is taxed. Maybe there's 160 left and that's reinvested. Okay. Now, investment strategy number 2 has the same asset number 1. It's refinanced. It returns the initial $100,000 to the investor and it continues on as a relatively de-risked investment. Now, the $100,000 return of capital is reinvested tax-free, as you know, into the same investment, asset number 2, as strategy number 1. So both of them are investing in asset number 2. One is using $200,000 minus the tax. The other one is using the original $100,000, which is being recycled. Now, where's it going to be in year 10? In year 10, the original investment and the new investment, into which both investment strategies 1 and 2 reinvested their respective amounts in year 5, both in both scenarios, asset number 2 is sold. Now, investment strategy number 1, it achieves less than a 4x multiple on invested capital due to the tax liability, taking a piece of the sale proceeds that were reinvested into asset number 2 in year 5. Capital gains are taxed at the end again. In investment strategy number 2, it achieves a 4x multiple on invested capital. Now, this is where the math gets a little tough. You might want to pause this. $200,000 from asset number 1, which is 3x the multiple on invested capital minus 100,000 already returned, plus $200,000 from asset number 2, which is the doubling 2x MOIC in 5 years. And capital gains are now taxed on both investments at the end of year 10 for investment strategy number 2. So perhaps surprisingly, not only does the investment strategy number 2 achieve about the same 4x MOIC over 10 years, but it outperforms strategy number 1 by the degree to which the tax liability chopped in to strategy number 1's reinvestment in year 5. And half of the capital gains are delayed in strategy number 2, which time value of money provides a more tax efficient scenario. So you may have all kinds of issues with this. You may say, hold on, the cash flow was less in investment strategy number 2. We're not considering cash flow as part of this. And yes, you would be right. And maybe that even balances it out. So these are about the same. I get all that. But hold on, there's another possibility here. Okay. What if the investment in asset number 2 fails and loses all the investor capital? Think about that. It will affect them both equally, right? Since they both invested in asset number 2. Isn't that right? No, it's wrong. And this is where risk comes in. If asset number 2 fails in both scenarios, under investment strategy 1, the initial 100,000 that turned into 200,000 less taxes turns into 0. It's a total loss. Well, not for everybody. Uncle Sam wins because Uncle Sam collected some of that tax in year 5. What about investment strategy number 2? The initial 100,000 turns into 200. Only the gain achieved during the first 5 years of the initial investment, that which was returned at refinance, or you could say it was the original amount returned, doesn't matter, it's 100,000 either way. That part is lost because it is reinvested into asset number 2 and that fails. So what's left? Well, the original 100,000 still turns into 300,000. Like I said, 100,000 has been refinanced out, so there's 200,000 left. So there's still a 2.0 MOIC, multiple on invested capital, after 10 years. That's not fantastic, but it's way better than a total loss. So this is way better. Investment strategy number 2 was only partially exposed to the second round of risk from the new investment. Okay, hope that made sense. We're not done yet, though. The bottom line is this. Regardless of what the IRRs might look like on paper for investment strategy number 1 and 2, the total return matters more. And that one is achieved by investment strategy number 2 is both nominally superior and exposed to less risk if something goes wrong. Investing into shorter term, higher IRR investments one after another exposes an investor's initial investment capital to repeat risks with each new investment. It's like playing a game of musical chairs. You know how it goes. When the music stops, will your capital have a chair or not? Here's another analogy. Each round of risks is like a professional athlete sustaining a subconcussive impact. How many of those can that athlete sustain before the big one comes along that takes them out of the game for good? Now, you may say, hold on, what if I took that $200,000 in year 5, the 100 became 200, which really became 160 because of capital gains, I'm assuming here. What if I took that 160 and put it in 2 or 3 assets? That's a good idea, but that's more effort. And as a left field investor, you know that it's a lot of effort to do due diligence on these operators. Look, I'm an operator. I know. I mean, I'm a fund manager at least. And so I know that people do a lot of due diligence on this and on us, and they should. We do a ton of due diligence on everything we invest in. I know how hard it is. Last year, we looked at 515 deals and we only invested in 11 of them. And we already knew 7 of those. We already had invested with 7 before. So only 4 new ones out of 515 last year. It's a lot of work. It's a whole lot of work to look at a whole lot more deals just to get 2 or 3. Is it worth it? Yeah, that would actually take care of some of this problem. But here's my point. It's not always better to do a 5-year deal. It's sometimes as good or better to do a 10-year deal, especially if you know the operator and you can pull some money out along the way. So I'm convinced of these longer hold times. For these reasons and more, my fund, Wellings Capital's mission, is to perform due diligence that you would undertake on your own if you had the time and talent and team to do it yourself. And additionally, we believe that the diversification we provide helps guard against this total loss that we talked about above. So now, before we wrap up, I want to discuss another very closely related topic, and that topic is liquidity or illiquidity. Honestly, I added this on because I really, really wanted to hit this, and I also needed to fill more time today. So many investors want a shorter hold time, believing it will lead to better returns. Does it really? Other investors are concerned about illiquidity, which results in a lack of optionality. In other words, they say, I don't know, I might want to do something else. I might come across some big med tech crypto strategy next, in 3 or 4 years. I might want that money back, or they might want it for other reasons. Many smarter, larger, and wealthier investors strongly prefer the benefits and the premium resulting from illiquidity. Trust me, it's huge. And I'm going to explore this strategy before we sign off today. Okay. So I think this is probably the more important part of the webinar. So if you're still with me 20 minutes in, I think the best is yet to come. Now, I'm not bragging, but I did take this picture with my iPhone last year. I'm being a little silly here. I spent more time in California last year than usual. My daughter got married in September in Northern California. And on one of the trips, I had the opportunity to meet two guys who are perhaps Wellings Capital's savviest active investors. I took this photo from the waiting area on the 30th floor of a financial tower overlooking the San Francisco Bay. Now, these guys are both former partners of one of America's top hedge funds, and they broke away to start their own hedge fund about 5 or 6 years ago. And they've raised something like $9 or $10 billion for that. Now, when I got in their conference room, I had the chance to describe our preferred equity strategy. And if you've been around, you know I discussed that preferred equity strategy on 2 other LFI lunch and learns. And they said I should get all the preferred equity I can, that our company should. And I think I told that story before. Pretty sure I showed this picture before. But I didn't mention what he said as I was leaving his office. I was walking down the hall, and as he followed me, he said something that surprised me. He said, "People don't appreciate the power of illiquidity." I turned around and he saw my puzzled expression, so he elaborated. He said, "I could raise $50 billion like that if we," that means his hedge fund, "could consistently achieve 10% returns." 10%. But he said, "I'd have to be illiquid to get 10% returns consistently." He goes, "You guys," meaning my fund, Wellings Capital, that he invests in, "on the other hand, you'd be disappointed if you had only 10% returns." That's, excuse me, that's the power of illiquidity. Wow. That's pretty powerful because I've often viewed illiquidity as a liability, something that holds people back from investing with us. People say, I don't really know if I want to tie up my money for 10 years. I don't know if I want it to be illiquid. I want to have access to it." But here's the most successful hedge fund manager I've ever met complimenting me on illiquidity as a feature. And it got me thinking and reading and researching and talking with others. And the result is what I'm going to share with you right now. I really hope it helps you think through this issue and enlightens you like I've been. So, what's so bad about illiquidity anyway? Why do people hate it? Well, um, Investopedia says liquidity refers to the ease with which an asset or security can be converted to ready cash without affecting its market price. Now, in talking with a lot of prospective investors of Wellings Capital, you would think illiquidity was the worst thing ever. We regularly hear from them saying, hey, I think I don't want to do 10 years. I don't want to tie up my money. I want to have access. Can I get it out whenever I need it? And we don't want those folks to invest with us because we only want people whose values and their desires and goals align with ours, right? Now, many of these investors have a valid reason to want liquidity. One of them was starting a new tech startup. Others had medical issues or healthcare issues or college tuition coming up. And they knew that they would need that cash. These are very valid reasons and good reasons not to invest or, to want their capital back if they had. But there's an invalid reason. It's called familiarity and bias. Familiarity and bias is not a good reason to stay liquid. Basically, this is a cognitive bias that prefers liquid investments because they're used to that. They're used to going to the bank and getting money when they want it. They're used to being able to cash in stocks, bonds, ETFs, mutual funds whenever they want. And just because that's familiar doesn't mean it's best. There must be a reason that so many of the world's wealthiest and most successful investors heavily weight their portfolios toward illiquid investments. I think this is going to surprise you. So let's ask the question, how do the wealthiest of the wealthy invest? Savvy investors, institutional investors, wealthy investors share an apparent bias toward illiquid investments and corresponding long hold times. Of course, they invest in liquid market investments too, but let's consider a few examples. First of all, let's look at our friends at Berkshire Hathaway. Warren Buffett, Charlie Munger, arguably the savviest investors of the past century, or maybe of all time. Berkshire has created its own illiquidity in at least two different ways. First of all, they have full ownership of a lot of companies. They can't trade these in whenever they want. They can't trade a piece of that on a dime, sell stock out of it. And their large stakes in other firms make their holdings somewhat illiquid. I mean, if they own 50%, let's just say, of Heinz ketchup, it's just not easy and sensible for them to trade it in quickly. But secondly, Buffett and Munger have created effective illiquidity through their self-imposed discipline. They plan to hold stocks for a very long time. Warren Buffett said, if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Pretty radical view. Buffett also said, our favorite hold period is forever. We're just the opposite of those who hurry to sell and book profits when companies perform well, but who tenaciously hang on to businesses that disappoint. Peter Lynch of Fidelity Magellan fame, Peter Lynch aptly likens such behavior to cutting the flowers and watering the weeds. So that's a few quotes from Buffett. What about his partner, Charlie Munger? He gets his own slide. Charlie said, the big money is not in the buying or selling, but in the waiting. So if you're a left field investor, if you're watching this webinar today, you're probably familiar with waiting. You're probably here because you already believe this, but I wanted to bolster your belief with some history, with some facts, and even a little bit of math. So how do institutional investors invest? That's how, Berkshire Hathaway, some big wealthy people do. What about institutional investors? Institutional investors have access to capital most of us would only dream about, and they heavily favor illiquid investments. I don't have time to go into all this right now, but I'll tell you one story. Did you hear about Yale? The Yale endowment made history when its new manager, David Swensen, broke away from the pack in 1985 and started making radical investments in alternatives. Now, university endowments need three things. Number one, they need income to fund school operations. They need growth to stay ahead of inflation. And third, they need safety to avoid managers getting fired. Now, managers traditionally invested heavily in liquid assets like stocks and bonds. But Swensen radically departed with a move toward alternative assets like venture capital and real estate, and he even invested in leveraged buyouts. You're going to love this. Here's a surprising statistic for you LFI folks. Swensen and his successors allocate less than 3% of their portfolio toward U.S. public equities. Don't you love that? Don't you feel like you're in good company now? He's done pretty well. We're going to talk about how he did in a minute, but here's Yale's target asset allocation for 2021, which is the most recent year I could find their allocations published. Okay. So check this out. They've got domestic equity, 2.25%, but they're in venture capital at 23.5, over 10 times that. Leveraged buyouts, real estate, bonds and cash, not much. Natural resources. They're in all kinds of other stuff. Now, the results have been staggering. Listen to this. According to Yale, when Swensen assumed the management of the endowment in 1985, it stood at $1.3 billion. During his 36-year term as chief investment officer, His stewardship led to, remember, it started at 1.3 billion, led to 57.6 billion of investment gains for Yale. And on top of that, 21.8 billion of spending along the way to support Yale's operations. Wow. Yale is the only Ivy League school that reported a positive return on the endowment holdings in 2022. No surprise, given that they still have this long-term mindset and this focus on illiquid assets. Now, you might notice here that while Yale holds 7.5% in bonds and cash for unexpected liquidity needs, the endowment clearly does not have a significant focus on liquid assets. And I find it personally satisfying that Yale holds over 4 times as much real estate as they do stocks. Pretty cool. Now, that's good news. We've talked about great investors, Buffett and Munger. We've talked about institutional investors like Yale. What about the wealthiest, the ultra high net worth investors? I love this graph. I think you left field investors are going to love it as well. Let's look at the investment strategies of these folks. This graphic was actually borrowed from Origin Investments, and they based it on data they got from KKR. Now, we can't state that every alternative investment is illiquid and long-term, but my experience says that most are. Now, look at the difference between ultra-high net worth investors, and that's in brown, and high net worth investors in gold. Note that ultra-high net worth investors hold a significantly higher portion of their assets in alternatives than in stocks, or bonds, or cash. Now, alternatives would include a wide variety of asset types. So which type do the very wealthiest investors favor? Well, Knight Frank had a 2023 version of the Wealth Report, and that 2023 report says that the ultra high net worth investors prefer real estate as their top investment choice for building wealth by a high margin. Powerful. Screenshot this, show it to your relatives at Thanksgiving, and you will be in good company with these high net worth investors. Not bad to be high net worth, but look at the difference. I mean, look at alternatives, almost double for ultra high net worth as high net worth. They must know something. So our premise today is that illiquidity is not a liability, it's actually a benefit. Now, we've discussed illiquidity and its often negative reputation among retail investors, and we've considered how many savvy investors embrace illiquidity as a benefit. Let's get into specifics. What specific tangible benefits do liquid or illiquid and long-term assets provide to investors? Now, as we review these, please note this caveat. I'm not arguing that these benefits flow directly from illiquidity. Some of these advantages just happen to coincide with long-term illiquid investments. Yet these benefits are truly tangible. I also realize that this is usually dubbed the liquidity premium, but that didn't make sense to me. The premium goes to the illiquid investor. So I call it the illiquidity premium. And I think that's certainly way more accurate. Now, all things being equal, including profits and wealth creation, most investors would prefer the optionality derived from liquidity. Okay. In other words, most people would prefer having access to that money, and I get it. But all things are far from equal, as my hedge fund manager friend pointed out. The illiquidity premium. So why are investors willing to take a lower return for liquidity? Investors forfeit flexibility when investing in illiquid investments. This limits the investor's ability to quickly alter their strategies and allocate elsewhere. The market effectively requires a premium to compensate smart investors for this loss of optionality. This premium often translates to a much higher return over a long time frame. How much higher? Well, a 2016 time weight return comparison was conducted by JP Morgan between the Burgess Corporate Finance and Venture Capital Fund and both the MSCI World and S&P 500 indices. And it revealed a 1-year illiquidity premium, that's only 1 year, of 10.4% and 7.2% in respective studies. Other studies, which we're not going to cover today, have said that over longer periods of time, there's a 4 to 5% premium for illiquidity. You can reach out to me if you want to get more information about that. Actually, I'm going to give you a link at the very end to tell you where to get more. So what are the benefits of illiquidity? Now, we've discussed the premium. The premium, again, is that you're going to get 4 or 5 or 7 or 10%, according to these studies, more for holding illiquid assets. But there's some other real tangible benefits on top of this. And I think for us as mere mortals, these benefits might be worth as much or more than the premium I already discussed. So we get the premium, but I'm also going to discuss 8 real benefits, and you can see if they make sense to you and if they make sense in your investing strategy. So our first benefit is lower impact from taxes and friction. Now, we already touched on this about 20 minutes ago in the first part of the webinar, this lower impact from taxes. Longer-term investors forego capital gains for years compared to their short-term holding counterparts. The cumulative impact of kicking the tax can down the road can be substantial. Also, longer holds avoid excess friction costs like broker commissions, loan origination fees, and other legal costs and fees. Buffett has often stated that most investors significantly underestimate the impact of friction costs like taxes and these other things we mentioned. So Buffett believes it. I believe it. I think it's pretty obvious that it's true. This is an additional benefit, and that's lower impact from taxes and friction. Second, reactive selling. This may not be you, but a lot of people do have issues with this. So billionaire fund manager and author Howard Marks has made a career from investing against crowd psychology. He wrote an excellent book that I highly recommend. It's called Mastering the Market Cycle, Getting the Odds on Your Side. Now, Marks has consistently profited from investing against the herd of reactive buyers and sellers in over a half century in the business. As humans, we are most likely to buy and sell at precisely the wrong times. That's a quote from Marx. Not to sound condescending, but I'm convinced that, this is me talking now, but I'm convinced that investing in illiquid assets has saved me and our investors from making a myriad of bad impulse decisions, especially in turbulent times. So a second benefit is illiquidity fights against reactive selling. Third, it lowers the risk in turbulent times. Now, long-term illiquid investments are considered riskier by nature. But are they really? In practice, illiquid investments often perform far better than liquid assets during turbulent times when investors are desperate to get their cash out. Now, a Penn Mutual study showed that theoretically liquid assets like ETFs suffer when many investors attempt to exit simultaneously. And you know this by nature. The study compared ETF price data, what they traded for, from the 2008 crisis to the net asset value of these same funds. This revealed a disparity as high as 11% on high yield ETFs at the height of the crash. Now, this report concluded that investors who rode out the liquidity crunch fared far better. Despite our best intentions in good times, humans often sell liquid assets at exactly the wrong time. Now, here is the data from this Penn study. You can freeze frame here and take a look at this when you want. But the point is, often the net asset value and the trading price are far, far different in the middle of turbulence, which usually goes against the investor. Obviously, when a lot of people are trying to sell, the price is abnormally low. So lower risk in turbulent times is another benefit of illiquidity. Another one is asymmetric opportunities. This is huge. Now, the efficient market hypothesis is right most of the time. I learned this in my MBA program. I'm sure you've heard of it. Buffett and other great investors prove that overall it's true. There's also very significant exceptions. The problem is most of us aren't as good as Buffett and Munger. Most of us can't find those exceptions in public markets. There is rarely a good deal in a public market. Why? Because of the broad dissemination of information and the massive number of eyeballs studying it. There really are very few good deals on the stock market. If you heard about it from your Uber driver, it's probably not a great deal. It could be. Fully liquid public shares are typically priced precisely where they should be. Just think about that. By their nature, real estate and venture capital is totally different. It's very hard to value these things accurately, and it's very hard to efficiently get information. I mean, a fourplex in, Riverside, California, it's not seen by millions of eyeballs around the world on public markets. A self-storage facility in Lynchburg, Virginia, that's understaffed, poorly managed, has terrible signage. It's probably not going to be seen by tens of thousands or millions of potential investors. So by nature, these mom and pop opportunities have a lot of potential intrinsic value and potential value add. This value is typically only mined by investors who forego the instant gratification of liquidity offered by public equities, and they embrace illiquidity. And the rewards for this can be great. Now, these liquid assets are often ripe for skilled operators who can add value and enhance returns. This opportunity is not as reliably available when investing in public stocks, like I've said. And as I've said many times, I think if Warren Buffett could start over, let's say it was 1953 again, he was 23 years old, and he could start over, I think he'd be much, much happier doing real estate than public equities. Think about it. He's built his whole fortune on finding value where nobody else could find it. And he's got like 140, 150 billion in cash because it's so hard to find value. Lots of opportunities in real estate. Come on in, Mr. Buffett. You're only 93 or 94 this year. You should join us in real estate. So asymmetric opportunities is another benefit of illiquid investments. There's also lower timing risks. Assets with shorter hold times are likelier to be boxed into a corner to sell at just the wrong time. Operators with a short-term view are more likely to finance with shorter term bridge and floating rate debt. In my experience, short-term operators are more likely to rely on market forces like compressing cap rates to create value because they don't have time in many cases to create value by, changing things around at the assets. Operators with a long-term view are not guaranteed a better outcome, not at all. But they typically have a mindset that gets fixed rate, not floating rate debt. They have longer hold times and they can ride through inflation scenarios, downturns in the economy. They're not forced to sell in 2 or 3 years if they have a 10 or 12 year debt and 10 or 12 year hold time. So these investors have much more flexibility. They have much more opportunity, much more optionality. It's kind of ironic. Investors lose optionality when they invest in illiquid assets, but the asset operators themselves gain optionality because they don't have to sell quickly. And this becomes an inflation hedge through times like this. I love it. Very exciting. Another benefit of illiquid assets is correlation and diversification. Now, you probably know that real estate and other illiquid assets often have low correlation to the stock market. Yale's endowment certainly benefits from this feature. Now, regardless of their underlying operating performance, liquid public equities are often subject to the mood on Wall Street, a CEO scandal or a random tweet or a war in the Middle East. You don't get that with real estate for the most part. Investing in illiquid assets largely avoids these landmines and provides diversification for some with portfolio for people who have money in public markets. We believe at Wellings Capital that it's best to diversify across asset types, operators, geographies, strategies, and properties. And again, if you saw my last few lunch and learns with LFI, you'll see that we also believe in diversifying across the capital stack as well. So, one more benefit of investing in illiquid assets is better investor sponsor alignment. Warren Buffett has complained for decades about corporate executives and how they are not aligned with the owners of their companies. Who are the owners? It's the shareholders. He observes that public CEOs are often rewarded for taking actions that benefit them at a cost to shareholders. Some of their actions focus more on the next quarterly earnings call than the long-term benefit of the real owners. And that's, of course, their investors. Now, look at private real estate offerings as a contrast. Other liquid investments like private equity, they reward investors first. Typically, the waterfall structure pays investors a preferred return before sponsors participate in these profits. The structure is transparent and it's legally established in advance through the PPM, not alterable in a boardroom vote where they can just vote to give the CEO a huge bonus for doing stuff that's short-term minded. Now, while this doesn't guarantee better management or a better outcome, I would certainly rather invest in this structure than in a public company. In fact, I have no money in public companies at all. Last, and if you've been around a while, you've heard me talk about this as well. Illiquid assets are often boring assets. When I sold my company to a public firm in 97, I thought, I'm a full-time investor now. Felt pretty good about myself, but I wasn't. I was a speculator. I was a shiny object chaser. Shiny objects are alluring, especially to entrepreneurs who want to get the same excitement out of their investments as they got out of building a company. But it's not smart. These jaw-dropping IRRs are bedazzling, like I said before, but it's not a way to build wealth over the long term. Paul Samuelson was America's first winner of the Nobel Peace Prize in Economic Sciences. And he said this, he said, investing should be like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas. Pretty powerful quote. Aren't we really just trying to build wealth here in the end with the least amount of hassle possible? That's what LFI is about. I define true wealth as having assets that generate reliable cash flow. My firm and a lot of you left field investors invest in long-term illiquid assets because you and I and we believe that this is the best and the ideal avenue to create true wealth. It's not about public equities or liquid or illiquid. It's about creating true wealth with the least hassle. And I really do believe that illiquid assets is the best path to get there. So, in summary, everyone needs liquidity, which is a cautious emergency fund. No sane investor would have 100% of their assets tied up in illiquid stuff. Everyone must determine their own liquidity comfort level, the amount of investments they can quickly convert to cash or keep in cash. We believe that investors who want to maximize their returns and wealth creation capacity should first achieve this comfort level and then have a strategy of considering illiquid, longer term assets for the investments above this level. The data is clear. The practice of large investors serves as a guide, and we believe the benefits far outweigh the downsides. I'm guessing you already believe this because you're here in the left field investor community. I just wanted to give you a reasonable defense you can make to your financial planner, your neighbors, your family members, friends who join you around the Thanksgiving table, and everyone else who views life and investing and wealth through the lenses of Wall Street casinos. For many savvy investors, illiquidity is genuinely a feature, not a liability. All right. Before we wrap up, if you've been around, you know I'm probably going to say this. I want to tell you something we're really passionate about as you think about long-term investing, as you think about investing for the very, very long term. Think about the issue of human trafficking. This issue is massive. Did you know if you took the record annual profits as of summer of 2023, a year ago, in ExxonMobil, Nike, Starbucks, and General Motors, if you added up their record profits and then added 20% more, that's the approximate profitability of human trafficking worldwide every year, according to the US State Department. There are more enslaved people in the world right now than any time in world history. And there's a huge problem for us who want to get involved. What do? A commando raid like that guy in Sound of Freedom? I'm not going to do that. Am I going to send money off to somebody I really don't know and encourage you to do the same, not knowing what they're really doing with it? We didn't like that. So we came up with a solution. We did the same type of due diligence on some nonprofits we do on commercial real estate investing. And we came up with a partner called AIM. AIM is located at aimfree.org. You can check them out, see what they're doing in Cambodia and Belize. They were featured in a 2012 movie called Nefarious, and that's where I first learned about them. And we have raised, donated, and influenced over $600,000 to aimfree.org in the last 3 years. You can go there directly if you're interested in getting involved, or you can join us at Wellings Capital when we do our big annual giving push in November or anytime. Now, if you want to contact us, you can take a screenshot here. You can get a hold of me at this calendar link at the top. You can learn more about AIM there at aimfree.org. You can get special reports from Wellings Capital at wellingscapital.com/resources. You can get a special a blog post about the power of illiquidity, which I just covered, at wellingscapital.com/blog/power-of-liquidity. If you want to email us, you can do that, invest@wellingscapital.com. I'm really grateful to Jim and Chad and everybody at the Left Field Investor family and all of you for joining me today. If you'd like more information on the math in the first 20 minutes of this webinar, you're going to be able to find a blog post on LFI going over the exact same math and the same comparison of the two hold times. And like I said, if you want to learn more about our view on illiquidity, you can get it at this blog post at Wellings Capital. Really appreciate you hanging in there for almost an hour today. Thank you for your time. And thank you again for being part of the Left Field Investor community. We hope you have a wonderful week, and we hope you enjoy your investments in passive investments, and we hope you enjoy Left Field Investor community. Have a great day.